Hello everyone, and welcome to this podcast. Today we're going to give you an update of the recent deliberations of the International Sustainability Standards Board, or the ISSB, up to and including the meeting in November 2022 on the proposals in the exposure draft of IFRS S1, the General Requirements for Disclosure of Sustainability-Related Financial Information, or S1, and the exposure draft of IFRS S2, the Climate-Related Disclosures, or S2, with IFRS standing for International Financial Reporting Standards. In today's session, our intention is to share an update of these deliberations in relation to the comments raised in the comment letters that the global EY organization, that we will refer to as EY, submitted to the ISSB in July. You can access the comment letters online by visiting ey.com/IFRS. At this site, you can also listen to two podcasts that the EY Global Corporate Reporting Services team previously recorded, which provide a high-level view of the EY responses to questions posed by the ISSB in its exposure drafts on S1 and S2. We're recording this podcast in November 2022. I am Katerina Mazzaki. I'm a senior manager in EY Global Corporate Reporting Services at EY GS LLP based in London, and I am part of the Sustainability Reporting team. I'm joined today by my colleague Rebecca Wilkinson-Blank, who is also a senior manager in EY Global Corporate Reporting Services at EY GS LLP based in London. She's part of the Sustainability Reporting team and previously worked in EY's Climate Change and Sustainability Services. Both Rebecca and I were involved in the comment letter process.
Thanks, Katerina. So to kick off our discussion today, I'm interested in hearing your thoughts about whether the feedback that the ISSB received on the two exposure drafts is consistent with the views presented in the comment letters that EY submitted.
That's indeed a good way to start with, Rebecca. Through its public consultation process, the ISSB received about 700 responses for each of the two exposure drafts, which actually reflects a significant and widespread interest in these topics across the globe. Overall, the responses expresses strong support for most of the proposals, and it appears that the views of respondents are broadly consistent with the comments that EY raised. In terms of how best to address the sheer volume of responses, the ISSB agreed on a plan for how to proceed, including what factors should be considered when they identified which topics to redeliberate.
That sounds like a reasonable plan. And so to start with S1, which, as you said, is the General Requirements Standard, and the discussions related to the use of the term enterprise value within the stated objective of the exposure draft and the assessment of materiality. As we know, the definition of materiality in S1 aligns with the definition of materiality outlined in the International Accounting Standards Boards, or IASB, their conceptual framework, as well as in IAS1. However, EY highlighted some concerns about how enterprise value relates to the assessment of materiality, and in particular the reference to market capitalization in the definition of enterprise value. EY commented that this could prove challenging in terms of applying enterprise value more broadly, for example, to unlisted entities. Did the ISSB discuss these concerns at all, Katerina?
Yes, the ISSB had a fairly detailed discussion about this point. So the inclusion of the enterprise value originally intended to capture a broader set of information compared to what is captured by the financial information. So this broader information should be provided with respect to what primary users consider material and what facilitates their decision-making today. So the intention was not for entities to make predictions regarding what the enterprise value might be in the future, rather to identify the information that the primary users would need today in order to understand how to think about the future. However, based on the feedback received, using the term enterprise value did not really achieve what was originally intended.
So what has the ISSB decided to do about this then?
Well, the ISSB decided to remove the definition of enterprise value and also its direct linkage to the objective and assessment of materiality. But the ISSB believes that having removed the term enterprise value, an anchor is still needed to facilitate the application of materiality in the context of sustainability-related disclosures, since the term enterprise value did not really achieve that. So this means that preparers will still want to know how to apply the already familiar concept of materiality, which is known to them from the IFRS accounting standards, in the context of sustainability-related financial information, which is a new area to them. Therefore, the ISSB agreed to further explore the issue of finding such an anchor and refer to aspects included in the integrated reporting framework as something that could possibly be used to assist in this articulation.
Thanks for that summary. I'm going to move on to another topic that the ISSB recently discussed, which is the use of the term significant. And based on the feedback from respondents, it appears that the use of this term has caused a bit of confusion. For example, how it relates to other terms in the exposure draft, such as material. Could you explain this in a bit more detail?
The ISSB's original intention was the use of the term significant to assist with the identification process. So that is to say, to help preparers narrow down the particular sustainability-related risks and opportunities from a broad range of potential topics that could be reported on. So the thinking behind this was that it would save entities from having to undertake an exhaustive search of all sustainability-related risks and opportunities. And on the other hand, the use of the term material is intended to relate to the actual information to be disclosed about those risks and opportunities. But as you point out, some concerns were raised. In fact, EY suggested that the ISSB should consider including a definition of significant and also consider introducing additional requirements on how significant should be considered in the context of other terms like materiality.
That sounds like a fundamental point to clarify. And how does the ISSB intend to address this overall?
Well, the ISSB acknowledged the concerns raised and decided to remove the term significant and instead to provide guidance about the process that entities need to undertake in order to determine the sustainability-related risks and opportunities. But it was interesting that the decision to remove that term, the term significant, increased the emphasis on the proposed sources of guidance that were included in S1, such as the Sustainability Accounting Standards Board, the ISSB standards. These sources were actually included in S1 so that entities can refer to when identifying sustainability-related risks and opportunities and the related disclosures if there is no specific IFRS sustainability disclosure standard for a particular topic. So EY commented on this by stating that the way this was drafted could be interpreted as if all the proposed sources should be considered, and that, as you understand, could be quite burdensome.
Yes, yeah, and it's a bit ironic because it's interesting that the rationale for providing a list of proposed sources was, as you say, originally meant to help reduce the burden on preparers, especially in terms of saving them time and effort from having to review the numerous sustainability standards and frameworks that are out there.
Yeah, that's true, Rebecca. But, S1 could also be interpreted as requiring entities to consider all of these sources. So the ISSB discussed the sources included in that list, but also whether these sources shall be considered or may be considered. In particular, the ISSB agreed that reference to the ISSB standards should remain in the list of sources. And this is because the ISSB standards provide disclosures across a range of sustainability topics that are designed with an investor focus and are industry specific, which is quite fundamental for the ISSB to achieve its goals. So the ISSB agreed to keep the consideration of ISSB standards as a requirement, but using the words an entity shall consider. And in doing so, if an entity determines that the application of the ISSB standards would not provide information that meets the requirements of S1, such as that the information is relevant for users of general purpose financial reporting, then this do not need to be applied.
Okay, that's helpful to know. And what about some of the other sources listed, such as the Climate Disclosure Standards Board framework and technical application guidance for topics such as water and biodiversity?
Well, that's a good question. So the ISSB decided to keep the reference to the Climate Disclosure Standards Board framework that you just mentioned, but clarified that the entities may consider this source, which means that such consideration is permitted but not required to be considered. For the rest of the sources listed, such as the most recent pronouncements of other standard setting bodies or any potential specific additions to the list, such as the Global Reporting Initiative, the GRI standards, and the European Sustainability Reporting Standards, the ISRSs, the ISSB plans to further deliberate those at one of its future meetings.
Let's move on to another fundamental issue that the ISSB recently discussed, which is the fact that an entity's sustainability-related financial disclosures will be for the same reporting entity as the related general purpose financial statements. So overall, this was well received by respondents, including EY, and the ISSB confirmed that this requirement would indeed be kept. However, there were some concerns highlighted by EY regarding the breadth of reporting, that's to say the boundaries of reporting, and whether the scope of reporting would follow the control concept as used in IFRS accounting standards, or whether control relates to the broader value chain concept.
Yeah, exactly. So EY raised that concern, and it was good to hear that the ISSB acknowledged the fact that what caused confusion amongst respondents was the term control that was used within the ISSB proposals, and whether that term has the same meaning as when it is used in the IFRS accounting standards. In fact, the ISSB explained that although the reporting entity that provides the information is the same for both the related general purpose financial statements and the sustainability related financial disclosures, the information to be provided should not be constrained by what has been recognized in the balance sheet. Rather, the broader value chain concept should be captured in the information provided, but the ISSB agreed that it is quite important to further explain that value chain concept within S1.
Okay, that's an important clarification. Another topic that was recently discussed is the proposed requirement to disclose comparative information for the previous period for all metrics disclosed in the current period. How did respondents react to this?
So the reaction from respondents was not on providing comparative information in itself, but focused on the requirement to reflect in the current period updated estimates for that comparative information. So EY noted that having a different approach from what entities are doing in the IFRS accounting standards might be quite challenging in practice. For example, the continuous tracking of previously reported estimates and measuring them against their actual outcomes could be quite burdensome. But having said that, EY also acknowledged that it may be necessary to update estimates in the context of sustainability-related financial information. For example, when reflecting better or more up-to-date information, which is often the case for Scope 3 greenhouse gas emissions, the so-called GHG emissions, or when enabling trend analysis by comparing the progress made towards a particular target set on a prior baseline. Therefore, EY suggested that the ISSB provides further explanation so that entities can better understand the reasons for this different treatment.
And how did the ISSB consider these concerns?
So the ISSB agreed that the best way forward is to keep the proposed requirement for updating comparative estimates, but at the same time to clarify that the requirement applies to estimates for the previous reporting period that were disclosed in that previous period. For example, when using industry averages to calculate metrics and deciding to update the calculation methodology to improve the estimation accuracy. It was also clarified that this requirement does not apply to forward-looking estimates, For example, when disclosing expected expenditure on new equipment for a future year, and the price of that equipment subsequently increases. Also, the revised comparatives will be required only for the immediately preceding period, and illustrative guidance will be provided to help entities apply the proposed requirement.
That sounds reasonable and also aligns with what EY recommended. The ISSB also discussed the timing of when to report sustainability-related financial disclosures and whether or not this information should be provided at the same time as the associated financial statements. EY didn't object to the proposed requirement, but did highlight some potential difficulties that could arise, such as availability of information, particularly upon the first application of the IFRS Sustainability Disclosure Standards. Did the ISSB address any of these concerns during the discussions?
Oh yes, Rebecca luckily did. And although the ISSB decided to keep the proposed requirement for simultaneous reporting, it also decided to introduce a transitional relief to allow later reporting of the sustainability-related information, the articulation of which will be decided at a future meeting. That relief will be available for a short period of time, but the exact duration will be decided as part of the discussion on the effective date of the requirements.
So let's switch gears a bit and focus on S2, which is the climate-related disclosure standard, and starting with the discussions on Scope 1 and Scope 2 GHG emissions. There was broad agreement amongst respondents, including EY, with the proposed requirements to disclose absolute Scope 1 and Scope 2 emissions. But at the same time, some concerns were raised. Is that right?
Yeah, indeed, Rebecca. So the feedback which EY agreed with revealed the need for greater clarity when it comes to provide separate disclosures for consolidated entities and other unconsolidated entities. Was that considered by the ISSB?
So these concerns were acknowledged by the ISSB, but it decided to keep the requirements as proposed and agreed to require entities to separately disclose Scope 1 and Scope 2 emissions for consolidated entities and for unconsolidated entities, such as associates, joint ventures, and affiliates. The ISSB also agreed with requiring entities to disclose the approach used to include such emissions for unconsolidated investees and intends to develop additional guidance to help further clarify the requirement.
Thanks, Rebecca. So what about Scope 3 GHG emissions, which relate to the indirect emissions that occur in the value chain of the reporting entity, that of course includes both upstream and downstream emissions, and actually tend to generate a lot of interest from the market, isn't it? So, for example, under the current proposals, I know that Scope 3 GHG emissions would be a required disclosure, and that includes the consideration of the 15 Scope 3 GHG emission categories described in the GHG protocol. However, I also know that respondents' feedback raised a number of concerns about the challenges associated with this requirement, such as data availability or data quality, isn't it?
Yes, you're right, Katerina. So respondents did indeed flag concerns about data availability and quality, and EY also asked for additional clarification to confirm whether these disclosures would be subject to materiality. Given the potential challenges, like you just mentioned, EY also suggested that the ISSB consider a phased-in approach for this requirement. So essentially, to allow entities more time to strengthen their internal processes and controls, to collect the necessary data, and to improve the quality of disclosures. The ISSB also agreed to consider further amendments, for example, potentially introducing a later effective date for Scope 3 GHG emissions, as well as developing additional implementation guidance to support entities when applying the requirements.
That sounds quite helpful. And I also know that in relation to measurement methods, the ISSB confirmed that disclosure of Scope 3 GHG emissions would include information about which of the 15 Scope 3 GHG emission categories of the GHG protocol are included within the entity's measurement of Scope 3 emissions. But despite the large support of the use of the GHG protocol, EY raised concerns about the fact that the initial version of the GHG protocol is over 20 years old and was actually drafted for a different purpose than being referred to in a sustainability disclosure standard. What did the ISSB discuss in relation to this?
So the ISSB decided that entities who use a measurement approach that is different from the GHG protocol can continue to do so for a defined period of time, which has yet to be determined, before being required to apply the GHG protocol. That said, if entities use a different measurement methodology due to specific jurisdictional requirements and/or regulations, such as the case in France or Japan, for example, then entities will be allowed to continue to use that different methodology to help avoid duplicating their reporting.
Thanks, Rebecca. So I know that the ISSB also discussed the topic of climate resilience, that is the capacity of an entity to adjust to uncertainty related to climate change. Did the ISSB make any decisions in this regard?
Yes, it did. So the ISSB discussed the proposed requirements related to scenario analysis and effectively confirmed the use of scenario analysis to assess climate resilience, and that entities will be required to disclose the results of the analysis as well. The ISSB did acknowledge concerns raised by respondents, including EY, regarding the wide interpretation of what actually constitutes scenario analysis. And to help address these concerns, the ISSB agreed to amend the definition of climate resilience to clarify that it encompasses the resilience of an entity's operations in addition to its strategy and business model. And this also aligns more closely with how other standard setters and regulators define climate resilience, including the European Financial Reporting Advisory Group. Lastly, the ISSB also agreed to develop application guidance to help entities when it comes to choosing relevant scenarios and in preparing the related disclosures.
Okay, and how did the ISSB respond to feedback related to the reference to alternative methods for assessing climate resilience?
The ISSB acknowledged that the reference to alternative methods could indeed result in the use of a wide range of alternative approaches that might ultimately impact the comparability and usefulness of disclosures. The ISSB therefore decided to remove the reference to alternative methods and will instead carry out additional work to provide guidance to entities on which climate scenarios they should be using, and in particular scenarios that are commensurate with an entity's size, capabilities, and level of exposure to climate-related risks. And the ISSB further agreed to reference and indeed build upon the guidance on scenario analysis that the Task Force on Climate-Related Financial Disclosures, or TCFD, has previously published, and will take this into consideration when developing additional application guidance related to S2.
Sounds helpful, and thanks, Rebecca, for that. And the ISSB also discussed the proposed requirements on strategy and decision making, including transition plans and climate-related targets. Did the ISSB consider the concerns raised by respondents related to this topic?
Yes, so it did, and essentially the ISSB confirmed the proposed requirement, but also acknowledged concerns over whether or not an entity would be required to develop transition plans and/or climate-related targets in the first place. So in response to this, the ISSB clarified that the requirements are meant to facilitate disclosure from entities who already have a transition plan or who have already set climate-related targets. So overall, entities are not required to develop these plans or targets if they don't already have them in place, or if they're not required to have them by jurisdictional legislation or regulation.
But Rebecca, I know that EY also suggested that additional requirements about the underlying assumptions of a transitional plan information would be useful. I guess that would also help facilitate greater transparency about how an entity intends to transition to a low carbon economy. Was this discussed at all by the ISSB?
Yes, you're absolutely right. And the ISSB essentially decided to introduce an additional requirement for entities to disclose the underlying assumptions made, as well as any dependencies identified when developing their transition plans. So, for example, an entity might assume a rapid uptake of new technology in their transition plan, which in turn will help an entity achieve their climate-related targets. And the ISSB agreed that this type of information is important to disclose.
So, Rebecca, I know that climate-related targets were also discussed by the ISSB, but I understand that although a number of recommendations were considered, the ISSB raised several concerns, and therefore more work will need to be undertaken before the ISSB makes any firm decisions on that.
Yes, you're right, Katerina. And I'll just add that there was an agreement on introducing a new requirement to specifically name which latest international agreement on climate change an entity is referring to. So, for example, the Paris Agreement or a local version thereof that an entity is focusing on. And this is something that EY also recommended, citing that this level of detail could help facilitate comparability across entities.
Well, Rebecca, we certainly covered a lot today. It has been a very busy and productive period for the ISSB. While we covered some of the key areas that the ISSB has redeliberated, note that these discussions are ongoing and we expect equally busy agendas in the coming months until the finalization of S1 and S2, which is expected early in 2023. And with that, I'm going to conclude our podcast where we have provided an update of the recent ISSB deliberations on the draft S1 and S2 in relation to comments raised by EY. Both Rebecca and I thank you for listening in, and we wish you a great day.